do bond funds outperform when there is an announcement of a scheduled monetary policy committee meeting, or there are rumors and news items suggesting that there could be a rate cut in the near future? Hello everybody, welcome to my YouTube channel. I'm your learning partner Sushila Hariharan with over 2 decades of experience in investment banking and global markets and more than a decade of experience in training and consultancy in the field of global markets, hedge funds and investment banking. I bring to you videos that are content centric, research focused on topics in this field. So let's analyze this. A bond fund is a fund that is largely invested in bonds. Bonds are fixed income securities that pay coupon to the investor at regular points of time, and in the case of zero coupon bonds, they pay coupon on maturity. So let's analyze, why do bond prices move in anticipation of news of a rate cut or a rate hike. So let's take the example of a company, ABC company, that has issued bonds that are paying a coupon of 8% per annum for a period of 5 years. At the time of issuance of the bond, the central bank of the country was borrowing at a rate of 7% per annum on behalf of the government. So therefore, we had treasury securities, or treasury bonds as they are called as, which are issuing bonds at a rate of 7% per annum. And there is this case of ABC Limited, which is paying a little higher coupon because obviously the credit rating of corporates play a very important role in the case of analysis of a bond's price. Maybe after a couple of years of the issuance of the bond, the interest rates in the markets have increased. Why do interest rates increase? Interest rates increase because of a capital liquidity drying up. So when this availability of capital is much lower than the demand for capital, and there is a very high demand for money, for liquidity, but that much capital is not available in the money markets, then the demand increases, price increases, so therefore the interest rates also will increase. Now in this case, in the years of 2021, 2022 and even 2023, we found that most countries in the world were suffering from very high inflation. Price rises was stupendous across all categories, whether it was commodities, whether it was metals, whether it was day-to-day living, whether it was oil and gas, any kind of item you might consider, the price rise was phenomenal. And because of this inflation, central banks decided to tackle the attack inflation with hiking interest rates. So what the central bank did was, it increased the interest rate, let's say from 7% over a period of 3 or 4 sittings to 9%. Now what will happen to the price of this bond? Remember, when the bond was issued, it was paying a coupon of 8%. At that time, the central bank was borrowing at 7%. Now, the central bank is borrowing at 9%. But this bond will continue to pay 8% because it is still having 3 more years left to maturity. What would happen to the demand for this bond? What will investors want? Will investors want a bond that is paying high interest or low interest? They'll obviously prefer paying bonds that are paying higher interest. Therefore, the demand for the bond of ABC Limited, which is paying 8% per annum, will start reducing. When the demand starts reducing, the supply of the bonds in the market will increase because investors who are holding onto the bond will now prefer to liquidate the bonds and put directly in treasury securities, which are paying much higher coupon and are relatively safer. Therefore, the supply of the bonds of ABC Limited will increase, the demand for the bonds will decrease, the price of the bond will fall. So whenever central banks increase interest rate, the price of the bond decreases. What happens in the reverse condition? As we have seen since 2024, especially in the United States, where the central bank, that is the Federal Reserve, has continuously been reducing the interest rates. In fact, even after Donald Trump won the election, they cut the rate by 25 basis points, and that was a huge cut that they did in the Fed rate. So this is what happens. When the interest rates come down, the central bank is borrowing at a lower rate. What would happen to the demand for bonds of companies like ABC Limited, which are paying a higher interest rate? Obviously, the demand for such kind of bonds would increase. The supply will be less because investors are holding on to the bonds. Investors are saying, look, this bond is paying much more than what the newer bonds are paying, because the newer bonds are paying much lower interest rates. So when they find that this is happening, what would they do? They hold on to the bond. The demand for the bond has increased, the supply is limited, the price of the bonds shoot up. This brings us to the equation that bond prices and bond yields are inversely related. It's very important. In fact, there are 4 or 5 parameters that bond investors and bond funds, including hedge funds that are trading aggressively in global bonds or euro bonds, will look at, and that is interest rates. And of course, they will look at interest rate arbitrages between different currencies. That's another video for another day. But at this point of time, we will discuss only about how hedge funds, which are holding a large portfolio of bonds, or which are bond dedicated funds, debt funds that are extensively invested only in bond funds, we find that when the interest rates are likely to go down, especially the central bank has decided to reduce the interest rates, the holding portfolio of the bonds of the bond fund will increase. What happens when the mark to market valuation of the bonds increase? The hedge funds will show a profit. So this is the situation that is currently happening now. That is, the largest holder of bonds are two entities in any economy. In the Indian economy, these are the commercial banks like your HDFC Bank, ICICI Bank, or government banks like Bank of Baroda, Punjab National Bank, and of course banks like Karnataka, Karur, etc. All of these banks hold a large portfolio of bonds, and when the Reserve Bank of India is expected to meet and announce on February 6th and February 7th 2025 about its stance on interest rates, then the market is expecting a 25 basis points, that is a 0.25 percentage cut in the repo rate, the rate at which the RBI will lend to the banks. This is a very significant rate cut. It's happening for the first time in almost 5 years. Remember, all of 2020 there was significant amount of rate cuts because we were dealing with lockdown, we were dealing with no economic growth, we were dealing with uncertainty, we were dealing with business lockdowns, etc. So there was a lot of rate cuts that were happening at that time. But ever since then till 2024, what the governments have been grappling with is inflation, and therefore interest rates have been increasing. Despite the fact that the United States had reduced the interest rates on multiple occasions in 2024, the Central Bank of India chose not to do so, and it's largely expected that on February 7th, when the Monetary Policy Committee, that's the MPC, announces, there will be a 25 basis point cut. This has led to a rally in the bonds. What is the meaning of a rally in the bond? A rally in the bond means bond prices have started to increase. When bond prices have started to increase, banks and hedge funds either are selling off the bonds at higher prices, or they are valuing them at much higher levels, and this results into the bond portfolio of the fund or the bank looking now much higher than what it was. And this has caused investors' demand or investor appetite in banking stocks to increase in the last few weeks. This has a direct correlation between bond prices and bank share stock performance, because there is a performance that the banks which are holding a large amount of bonds, if interest rates increase, then the bond portfolio value decreases. If interest rate decreases, the valuation of the bond portfolio decreases. This inverse relationship between bond prices and bond yields results into a massive churn in a bank's trading book, especially with regards to the holding period of the different bonds. Thank you so much for listening in.